Welcome everybody to the Ellsworth Advisors monthly recap for the month of July. I'm Kelly Keenan. This is my fellow managing director, Cameron Mealy. Today we're going to kind of walk through the economic numbers for the month of July, and then I will also follow up with how our portfolios have performed and what our thoughts are moving forward through the rest of the month. Cameron, why don't you kick us off with some economic data?
Perfect. Thank you, Kelly. Well, not surprising, second quarter GDP, at least according to the advanced rate from the Bureau of Economic Analysis, was a historic drop. Second quarter GDP was down 32.9%, and that's 32.9% on an annualized basis, so that's really an 8.25% drop just in the quarter. But to think about that number, 8.25% on a $20 trillion economy is a huge number. Where was the pain in the second quarter? Second quarter decrease in real GDP reflected decreases in consumer spending, exports, inventory investment, business investment, and housing investment. Basically, the entire economy.
Yes, exactly.
So, what we've seen so far this year is we saw a 5% decline in GDP in the first quarter, not unexpected. We saw a 32.9% decline in the second quarter. And because of the second quarter, the virtual shutdown of the economy, how bad the situation was, the Atlanta Fed in their GDP Now model is estimating that we'll see an 11.9% rebound or growth in GDP in the third quarter. So 2 negative quarters, positive third quarter. I think our assumption is that we could also see a negative then fourth quarter, and we could have a little bit of this seesaw until we really get the economy back on its feet.
Latest numbers I've been reading, early estimates for like the total year, anywhere from like 4.5% to 5% is numbers that have been thrown out to the downside. So, basically 5% shrinkage for the year.
Yeah, talking about $1 trillion of gross domestic product gone. Yep. Where are some bright spots? Well, the bright spot is in, again, our personal income and savings. We talked about this before. People are not out, they're not spending. They're doing a lot of online shopping, but not a lot of traditional retail shopping. So again, according to the Bureau of Economic Analysis, real disposable personal income, which is personal income adjusted for taxes and inflation, increased 44.9% in the second quarter after increasing 2.6% in the first quarter. Personal savings as a percent of disposable income was up 25.7% in the second quarter compared with 9.5% in the first quarter. That represents $1.5 trillion that consumers, rather than putting into the economy, have put into savings. Now, as we also talked about, U.S., we are not traditionally great savers. So will that money come out? Will that provide some short-term stabilization for the economy, or is that money that's going to permanently stay out of the economy? So basically, we've seen a $1 trillion loss in GDP. We've seen $1.5 trillion that would incrementally be put into the economy, taken out of the economy and put into savings. So, really a lot of headwinds to fight.
Well, that number also kind of lines up with the stimulus that was provided by the government.
Yep.
So, we have a long haul ahead of us to kind of get back to where we need to be.
We do have a long haul. Now, the other thing, another piece of information that is a little bit scary is, as we've already talked about in June, we had 4.8 million new jobs added. The consensus for July, that number's coming out this week, is only an addition of 1.36 million new jobs. So we saw the economy open back up. We saw people getting back to work. We saw spikes in COVID-19. We saw economies slowing back down. And, the job situation is scary. With that 1.36 million increases, the jobless rate will drop to 10.7% from 11.1%. So good news, but we lost the jobs very quickly, and it doesn't look like they're going to be coming back as quickly. On the other front, we do have both houses of both sides of Congress trying to figure out a stimulus bill. Looks like, within the next couple of weeks, hopefully they'll get to some sort of a consensus. And, we're going to see probably another multi-trillion-dollar spending by the U.S. government to prop up the economy. So the government's printing paper, printing money. They're obviously not afraid to. They feel that jobs, that the economy, are more important than their responsibility to the U.S. balance sheet at this point.
Bottom line, a lot of this is COVID-driven. Mm-hmm. The starting and stopping of various states and municipalities is driving the economic numbers. That's going to drive more stimulus, which is it's kind of filling in the gaps for the lack of economic activity, but the price of that is obviously the economy going further, or the government going further into debt, which, we're not quite sure how that movie is going to end. And, talking about the COVID, that's how it's affecting the economy, what the government's doing to kind of prop that up. COVID's also affecting what's going on in the markets. Just read a article this morning where they're tracking kind of the media narrative, what the, on a daily basis, what's kind of driving the headlines, what's getting the most print. And they grouped it between positive COVID news and kind of negative COVID news. And the reality is positive news creates bumps in the market to the upside. Negative news is pulling it down, and it's perfectly correlated. So a lot of what's happening is being driven around COVID. And, on that same note, there's a lot of misconceptions out there from the public as to really what's really going on with the facts on the progress of the disease, the risks of the disease. And I'm not going to lay these facts out to you because I think it's something everybody should be looking at themselves. But when you really look at where the facts are the municipalities, are the local governments, is the federal government taking the correct actions? Is it worth the pain to the economy when you really look at who's mostly affected by the COVID, where the real risks are? That's, it's a little bit disturbing, but then again, we're in a political season, or we're getting into a high part of the political season.
A lot of people are going to argue that this is a virus and it's going to be around. And until there's a vaccine, it's going to continue to circulate around. And shutting down the economy, staying at home, you're never going to eradicate a virus. Right. The only way you can is through a vaccine. So, we're going to see volatility. We've talked about that. It's a political year. We're in earnings season right now. Frankly, I think most pundits don't even care about earnings. Second quarter earnings are almost meaningless. It's going to be COVID, it's going to be politics, and it's going to be jobs.
Right.
And it's mostly going to be politics.
From the earnings standpoint, the actual numbers are not as important as trajectory. Mm-hmm. So if you see improvement, that's going to, improvement in earnings is going to help the market beyond just the actual numbers of earnings. So, July it turned out to be a good month. It was a good recovery month. For certain segments of the market. In July, the Dow Jones was up 2.38%, but year to date, the Dow is still down 7.39%. The S&P up 5.51% for the month. Year to date, actually cracked went into the positive. So the S&P is now up 1.25%. When we look at the Nasdaq, up 6.83% for the month. Year to date, the Nasdaq's up 19.76%. And I kind of want to stop there, take a couple seconds to discuss what's going on there. So year to date, Dow's down 7.39. Year to date, S&P up 1.25, Nasdaq up 19.75. And the reason we're seeing this big divergence is basically what's driving the Nasdaq, what's driving the S&P. And the reality is there's a handful of stocks that are really driving everything. And those stocks, Amazon, Microsoft, Apple, Facebook, those 5 stocks are driving everything. If you were to strip those 5 stocks out of the S&P 500, the year-to-date returns are going to look a lot like the Dow, which is down 7.39%. So,
well, those companies become such massive organizations, and because the S&P is weighted based on market cap, they can pull the entire index.
Correct.
496 stocks can be down, and 6 can be up. And It pulls the entire index with it. It's a little, I'm not a huge fan of that.
Well, we've seen this dynamic before.
Yes, we have.
And unfortunately, when we saw it was around 1999, 2000, the same dynamic started to play out. And that does have me concerned. Now, unfortunately and fortunately, we don't have a lot of exposure to those stocks, because what happened then when we saw the same dynamic play out with that kind of divergence was basically the tech wreck of 2000, 2001, where you had a handful of tech stocks kind of drive everything into the late 90s. And then when reality hit and the valuations were so extended, which they're pretty extended at this point.
PE ratios are high.
We saw basically a major market correction, and it took a long time for those stocks to recover. Microsoft, great example, peaked out in December 1999, hit its high, and didn't see that price again until 2013. So that's definitely kept me, it's definitely heightened my attention as to what's going on in the market overall. So that's kind of the dynamic we're living in. We'll talk about our portfolios in a second. Beyond the U.S., on the international front, the MSCI EAFE, the International Developed World Index, for the month was up 2.23% for the month. MSCI is still down 10.64%. Emerging markets for the month, they actually had a big month, up 8.42%. And year-to-date, emerging markets are only down 3.25%. So emerging markets have held up really well, and we are starting to see the developed, international markets pick up steam. Part of that is because the weakening dollar. And if you have a weakening dollar, which the dollar started weakening this month, that's going to juice up international returns. So that's really what's happening on a global standpoint with the markets themselves. With our portfolios, our growth with income portfolio, for July, it was up 4%. Year to date, up about 3.5%. So growth with income is held in there pretty well. Big winners, digital realty up 21%. Our emerging markets exposure up 7.43%. Apple had a great month, year to date is up 45%. Nvidia is up 80%. Gold's up 29%. So those were big. Those have been big winners year to date. For the month, gold up 10.55%. Gold kind of broke through a, kind of a resistance barrier, and we have good exposure to gold. We actually added to our gold position earlier in the month, and based on what's going on in the economy, we're going to let that run for a while.
It's a great hedge.
That's really that's why we have it.
Yeah.
It is strictly in there for a hedge. I don't see us holding gold 5 years from now, but we'll see. In the short term, we're going to continue to have it because it's definitely helped this portfolio. Berkshire Hathaway for the month was up about 9.67%. Nvidia, once again, year to date it's up huge, but for the month it was up 16.25. Apple up 16.37. Disney a little bit of a bounce up just under 5%, 4.87%. Really are, not a lot of losers during the month. Microchip gave up about 3.4%. So, growth with income, the balanced approach, having the gold in there, that's definitely helped us out. A little bit of tech exposure has helped us out. On the tech front, between Apple and Nvidia, we actually those ran up so much year to date. Apple we've held for a long time. We've actually cut down on those positions. We still hold them. We have nice positions in them, but we did shave off gains in those earlier in the month. Dividend yield, which is basically our dividend yielding, more conservative portfolio. It's been running more in line with the Dow Jones. For July, it was up 3.14%. Year to date, once again in line with the Dow, down about 7.6% or so. Kind of not surprising how that's reacting. Definitely minimal tech exposure. Probably the big detractor in there, Intel came out with some. Their earnings were kind of as expected, but their news was not great. So in July, Intel took a hit, took it on the chin. It was down 20%. Winners in July, UPS up 28%. Some of that online shopping kind of kicking in. Alliant Energy up 13%. Pfizer had a nice bump up 17% for the month. So, dividend yield just kind of plodding along. It's yielding about over 3%, so it's nice cash flow.
It's great cash flow in today's market.
We have a little ways to go, kind of in line with the economy, maybe a little better than the economy. So that's kind of what's going on in dividend yield. Price potential, which is, definitely more growth oriented. Here for July, kind of a disappointing July, only up 3.21%. Year to date, kind of, once again, more in line with the Dow, where typically price potential historically has been able to keep pace with or outpace the S&P 500. Not so much this year. Once again, it's because we have a little bit more of an eye towards valuation and quality in this portfolio. We had some good winners in July. Edwards Life Sciences up 13.5%. Genpact up 9%. Costco 7.6%. Some of the losers, ADP down 10.75%, the CBOE down 6.4%. So, with price potential, once again, it's, because of the quality focus, we've stayed away from high valuation stocks, more in line with the Dow right now. But we're not going to change tactics. I don't want to chase the hot stocks at this point in time. It will pay off, but we're just going to have to be patient with the price potential. Our small mid-cap portfolio, good month, up 5% for small caps. Year to date, we're down about 4.5%. So we're definitely outpacing the Russell 2000, which, for the year is still down 11.25, and for the month, the Russell 2000 was only up 2.76. So small caps are working, but they are volatile. For example, some of our winners, Tech Target up 21, just under 21%. Fulgent Technologies up 65% for the month. Verisight up 37%. So we have our big winners. From on the losing side, though, eHealth down 29% for the month. Kodiak Sciences down 14% for the month. So a lot of volatility in there, but in general, I think we're doing pretty well in the small caps compared to the indexes, and they're doing what they should be doing. So, as I mentioned before, we're not going to give up on our strategies. We're not going to start chasing the hot stocks, especially at this juncture of the road. It's really more of a patient story. We have to expect some volatility, whether it's just based on the latest COVID news, whether it's positive or negative on vaccine. That's going to be driving stuff in the short run. I think the market's assuming there's going to be some kind of deal struck from a stimulus standpoint. It's going to be
that could give us a nice little run up.
Yeah, it's going to be anywhere from $1 trillion to $5 trillion. Who knows where that's going to be? Probably somewhere in the low trillions. That'll juice things for the next couple months, and then as we get into election season, that's going to throw some more media headlines out there to expect. So we have to expect a lot of volatility there. So once again,
that's why you stick to your guns and you take a long-term approach, because we don't need the money today. So you got to keep it fully invested in the market. You obviously got to maintain your liquidity. Look to yield when you need income, but this is the slow game.
Yeah, we don't want to. Don't think, there's a lot of rough stuff out there, but the reality too is there's definitely a path out of this. And, when we look at the stock market, things are different than, today versus the late 90s, early 2000s. One is the amount of money that is being pumped into the economy. And the other big driver is interest rates. I mean, at that time, what were interest rates late 90s? Mid-single digits. Now we're looking at interest rates are practically zero. So, there's a natural tendency for money to continue to flow to the stock market because there's really no other place where you're seeing gains. You can say, gold, we're seeing gains, but gold's kind of a unique asset. Gold doesn't create cash flow, doesn't create profits or cash flow, unlike the equity markets. The bond market, generally, or fixed income generally produces interest. Right now, that interest is so low that you're having a natural gravitation to the stock market. And once again, we need to be patient, hang on, and like we've always been stressing for the last several months is if you have income needs or kind of unplanned expenses coming up that we're going to have to draw from the portfolios, please let us know as soon as possible, whether it's in the short term or the next 3-6 months out, so we can kind of get some dollars aside out of the equity market so we won't get burned by a downswing. And that's really how we want to manage things in the short term here.
And of course, if you have any questions, please feel free to reach out to us. We appreciate your trust and thank you for your time.
Thanks a lot. Have a great week.